Welcome to the Explainer. Now look, if just hearing the phrase business finance makes you want to literally run for the hills, you are in exactly the right place. Today, we're completely demystifying the whole numbers game. Seriously, I want you to completely reframe how you think about this. Business finance? It's not some scary chore. It's definitely not a math test you're doomed to fail. Actually, it's a highly learnable toolkit. Think of it as your ultimate survival gear, and honestly, your primary weapon for wealth building. By the time we wrap up here, you're going to see exactly how all these pieces fit together.
Okay, let's dive into this syllabus. We're going to build your knowledge step by step from the foundation up, so there's absolutely no cognitive overload. We'll start with the rules of the game, transition over to reading financial statements, move into managing your money actively, cover raising capital for growth, and wrap the whole shebang up with your financial tech stack.
All right, Section 1, the rules of the game. Pouring the foundation, let's get into it.
Before we can build anything, you gotta know the four cornerstones that hold this whole thing up. We're talking income, expenses, assets, and liabilities. Literally, every single financial concept we touch on rests on these four pillars. So, the crucial point is, to pour that foundation, we have to start with golden rule number 1. Your business finance is absolutely not your personal finance. You'd be surprised, but the most common beginner mistake is mixing the two. So no, you cannot buy your personal groceries on the corporate card. Do yourself a massive favor today, okay? Go open a completely separate business bank account. It is the mandatory, non-negotiable first step to actually taking control.
Now, what's really interesting here is how we can just shatter the biggest beginner illusion in business. We hear people bragging about their revenue all the time, right? But revenue, all that money falling into the top of the funnel, is really just a vanity metric. Profit? Profit is the actual gold at the bottom. It is exactly what's left over after every single expense is paid out. I mean, think about it. You could have $1 million in revenue and $0 in profit. Profit is the true lifeblood of your business, period.
Let's move to Section 2 and see how this builds. Reading financial statements. Framing the walls.
To really grasp the health of your business, you have to read the story the numbers are trying to tell you. And that story, it's told through the big 3 financial statements. First up is the profit and loss, or P&L statement. Think of the P&L as your business's report card over a specific stretch of time, like a month or maybe a year. It tracks your gross income before expenses, deducts all the costs, and reveals your net income right there at the bottom. It simply answers one huge question. Did we actually make money or lose money this month?
Next up, we have the balance sheet. Now, unlike the P&L, which covers a stretch of time, the balance sheet is basically a freeze-frame photograph. It captures your exact financial standing at one specific, exact moment. It shows what you own, those are your assets. It shows what you owe, your liabilities, and the difference between those two, that's your equity, or basically your business's overall net worth.
Finally, we've got the cash flow statement. And please, never forget this. Cash flow is king. This statement shows where cash is actually moving in and out of your business, in reality, not just, on paper. This is absolutely critical. Do you know how many highly profitable businesses have gone under? A lot. And why? Simply because they ran out of actual liquid cash in the bank to cover their day-to-day operations. It's wild, but it happens all the time.
Okay, let's rapidly translate some of this heavy financial jargon into plain English. COGS, that's cost of goods sold, which is just the direct cost of making whatever widget or service you sell. Operating profit, that's your profit before you even start worrying about taxes and interest. Depreciation and amortization, I know, big words, are really just fancy ways to track how the value of your physical or digital assets decreases over time. Retained earnings, that is just the profit you consciously decided to keep inside the business so you can reinvest and grow. And key ratios, things like return on investment or return on equity, those are basically your essential measuring tapes for performance. Understanding these terms is a real game changer. It gives you the power to properly forecast and plan your financial future.
Section 3, managing your money actively. Putting on the roof.
So to transition from just passively reading your past statements to actively taking control of your financial destiny, you absolutely have to build a working budget. And a great budget requires you to track every single dollar. That means correctly allocating your costs. You've got to distinguish clearly between your fixed costs, which are those predictable regular expenses like rent or, those software subscriptions you keep forgetting to cancel, and your variable costs. Those are the ones that fluctuate based on your actual production, like raw materials or shipping fees.
Once you have a handle on those costs, you can calculate your break-even point.
Honestly, this is your survival baseline. It's the exact moment when your revenue perfectly covers all your expenses. Anything below this, you are bleeding out. Anything above this, you're actually making a profit. But since wildly unpredictable things happen that can totally disrupt your cash flow and keep you from hitting that break-even point, you must maintain a business emergency fund.
I absolutely love this hard truth we pulled from the source material. If it doesn't make you money or save you money, cut it. Brutal, right? But if you aren't profitable yet, you need to be reviewing your financials regularly and trimming the fat. Efficient cost management is literally the absolute fastest way to improve your profit margins and make sure you survive the inevitable ups and downs of the economy.
Section 4. Raising capital for growth. Hooking up the utilities. Let's keep moving.
With the house build, it's time to hook up the utilities and really fuel the business with capital. You can do this by self-funding, maybe finding angel investors, or crowdfunding, but it mostly boils down to two main paths: debt versus equity. And this concept brilliantly illustrates the trade-off. Debt financing means borrowing money, like a term loan or a working capital loan, where your cost is the interest you pay back. It's kind of like a heavy ball and chain. You definitely need a strong business credit profile for this, and fair warning, over-relying on debt can totally kill your growth. On the flip side, we have equity financing. This means slicing up the pie and trading a piece of ownership in your business in exchange for that capital.
Okay, I want you to really think about this next question for a second. If all revenue just stopped today, how long can your business survive right now? Kind of makes your stomach drop a bit, doesn't it?
That is a seriously tense question. But hey, here's the antidote to that tension. You measure your survival using two crucial metrics: burn rate and runway. Your burn rate is exactly how much cash you're spending every single month. Your runway is how many months you can survive at that spending rate before you hit absolute zero. Knowing these two numbers, it's absolutely essential, especially if you're going to the table to negotiate for seed funding or planning to expand globally. It puts you firmly in the driver's seat.
And finally, Section 5, your financial tech stack. Installing the smart tech. Think of this as the ultimate cheat code. Modern cloud-based software basically automates all the heavy lifting of finance for you. Now, mastering all of this doesn't happen overnight, but let's rapid fire through a highly scalable tech stack you can use to elevate your operations no matter how big or small you are right now. You ready? We've got QuickBooks for all-in-one accounting, Float for visual cash flow forecasting so you never run out of liquidity, Stripe for seamless global payments, Expensify to basically automate all those annoying receipts and reimbursements, Planful for collaborative financial planning, Brex for corporate credit cards with killer high limits, Carta for managing your equity and your investors, FreshBooks for super clean invoicing and time tracking, Zero Projects to track profitability on very specific jobs, and finally Gusto to seamlessly handle your global payroll and HR compliance. Whew! Having these tools gives you the superpower to scale with absolute confidence.
So, we've covered the rules, the statements, active management, capital, and the whole tech stack. But the biggest takeaway I want to leave you with today is actually really simple. You do not need a finance degree to control your money. You really don't. You just need a growth mindset and the discipline to actually track your numbers. Because when you truly understand business finance, it hits you. You don't just run a business, you build wealth. So I'll leave you with this. What exact steps are you going to take today to start tracking your path to wealth? Keep those numbers strong, and I'll see you in the next explainer.